All right, what's up, everyone? Welcome to part 6 of the trading course. In this episode, we are going to talk about stop losses and what they are and how do you use them effectively. So, just a brief introduction to stop losses. All you have to think of them as is a level where your trade will get invalidated and so you get stopped out so that you don't have to be stuck holding bags. So, what do I mean by that? So, let's say you were looking at Bitcoin at about this point right here, where if you watch the video about buying breakouts, you would understand that this is a breakout of this trendline resistance right here. So usually when you buy a breakout, you place your stop loss right underneath the pattern, right nearby a swing low. So in this instance, when Bitcoin breaks out of this trend line, I would place my stop loss right here below the swing low pre-breakout. Because if the price were to fall back below this level, then your idea of buying the breakout would then be invalidated. Makes sense? Like a breakout is supposed to be, breaking out of the pattern and, starting something new. It's not supposed to fall back into the pattern. So in that case, if the price were to fall back into the pattern, then you would get stopped out because your trade, like your prediction for that trade, is wrong. And so you get out with a small loss. Now, I always like to say that in trading, it's okay to be wrong. In fact, everybody is wrong, and a lot of people are wrong a lot of the time. And it's okay to be wrong. The only thing that you should keep in mind is that you do not let any single mistake absolutely destroy your account. Because trading is a game of possibilities, right? There are no absolutes in trading. The way you win is by taking the higher probability trade over and over again for a sustained period of time. And that is how you come out ahead of 90% of the people out there. So in this case, because they are only a higher probability trade, right? A breakout is quite a high probability trade. I would say if you buy simply just buying breakouts and a retest, your success rate would probably hover around the, 68%, maybe 82%, somewhere around there, right? Breakout trading is like the training wheels of trading. It's generally very safe and it's generally very lucrative. But even though breakout trading might be easy and might be profitable, you still have to exercise proper risk management, and that involves using a stop loss so that if the trade were to go against your favor and your idea gets invalidated, you do not get stuck holding a fucking bag. Okay, holding bags in crypto is absolutely like one of the worst things that you can do, because then your money is tied up in that asset and you can't take it out. You can't do anything with it. All you can do is, come on, please recover. And trust me when I say it's not a fun place to be in. So that is just like a basic overview of how to use a stop loss. Basically, all you have to think of them is the point at which your trade idea gets invalidated. That should be your stop loss. Okay. So if I were to bring up, let's say, Market Cipher. So if you watch the EMA masterclass, right, and if you haven't, you better watch the EMA masterclass because there is so much knowledge in that video. Like literally the raw file was like, 50 minutes long? If you haven't watched it already, or if there are some things that you do not yet understand in the EMA masterclass, I need you to rewatch that video because it goes really in depth. So let's say you watch the EMA masterclass, right, and I always like to say that the 200 EMA is a very, very strong dynamic support and resistance in any trend. So perhaps in this instance right here, maybe you saw that the price broke below all these three major moving averages. So you are betting on price finding support at the 200 EMA. So what do you do? How do you set your stop loss? Long story short, you set your stop loss right below the 200 EMA. But what if you set your stop loss a bit too tight and there's not enough wiggle room for the price to play around with? So here is an indicator that I tend to use to set a stop loss, right? If you just go into indicators, go search up something called average true range. Now, if I bring this up, it is a little bit dark. It is a little bit hard to see, so I'm just going to change it to white. Okay, so in ATR right now, you can see that at least at this point in time right here, you can see that the ATR indicator is showing that the average volatility in Bitcoin is about $1,100 on the daily chart. No, sorry, on the 4-hourly chart. So in this case, it would mean that the average range, right, the average amount that Bitcoin moves in just a single 4-hourly candle is about 1,100, which means if you don't want to get stopped out prematurely and not allow the price enough room to wiggle around, you are going to want to set your stop loss one ATR value below wherever you are placing your trade at. So in this instance, if you had no way of telling how to place your stop loss, the ATR indicator is going to be really useful. So in this case, I just place it 1,100 points below the 200 EMA. So in this instance, it would be about 54,300. So right about here, which is about 2%-ish. But doing so will ensure that you do not get stopped out prematurely before your trade has a chance to move in the direction that you were expecting it to move. And if we just look at the previous example right here, this is the importance of not setting your stop loss too tight, because over here you can see that the price indeed did come down to find support at the 200 EMA, except it sort of went under the 200 EMA for a fair bit of time, about 2 days, before ultimately moving back in the direction that you were expecting it to. And if you were to have set your stop loss right below the 200 EMA, you would have got stopped out. So that's the importance of not setting your stop loss too tight, but at the same time setting it at a level where if your trade were to get invalidated, you can get out with just a small loss and not be stuck holding a bag, right? So that's method number one of how to set your stop loss. The second method is by using support and resistance lines. So if I were to be placing a trade at this point right here, I would look around, right, into the past, and I would try to identify areas of support and resistance. So right off the bat, I can see that this level right here had multiple reactions from price, right? This zone right here had multiple bounces of support. See, support here, support here, support here, right? So this is a strong level of support, which means if the price is going to drop beneath the 200 EMA for like just a short little moment, something like this, then you are going to want to place your stop loss right underneath this support line, maybe even one ATR beneath your stop loss, beneath this support. So in this case, I would place my stop loss 1 ATR, which is about 1,000 points. So my stop loss would be at about here. Now, what is the difference between using support and resistance along with ATR rather than just using ATR? So for starters, ATR just shows you like what is the average volatility in that given in a single candle at that time frame, but it doesn't tell you much more than that. So what if the volatility increases during that time? Then you would get stopped out prematurely. So what you do is you identify support and resistance lines, right? At the moment, we know that this line is a very strong line of support, which means that if the price were to fall below and come down to this line of support right here, you can even add to your position instead of just, exiting the trade at a loss. So in this case, if you are still expecting the price to move upwards and find support at the 200 EMA, then this is what you do. You identify support and resistance lines, and then you use the ATR indicator to place one ATR beneath that line where you are expecting price to find support before ultimately moving upwards. And again, both methods work. You just need to figure out what is the right way to set your stop loss in any given market conditions. So that was like example number one, right? That's breakout trading. Breakout trading, you set your stop loss right inside the pattern, because it's not a breakout if it falls back into the pattern. Makes sense? So in the other instance, let's take a look at like patterns, right? So right now, I'm just going to go onto a random chart. In this instance, it's going to be Tomo. And we are going to take a look at technical patterns, right? How do you set a stop loss for technical patterns? So if you just look back to this point right here, you can see that Tomo was forming sort of a ascending triangle, right? And let's say you were trying to front run the pattern, right? Front running simply means that you buy at the bottom trend line instead of waiting for the breakout before buying, right? That way, if you buy here, by the time the price gets to the breakout, you can take profits there while people are, buying up here, but you're smarter than them, so you're taking profits there. But this is exactly the reason why I say front running is generally much more riskier than simply buying a breakout. If the breakout is considered like the training wheels of trading, front running is like taking both of your training wheels off and now you're cycling for real. Because this is where the big boys play, and this is where a lot of people will absolutely get destroyed if they do not have proper risk management and know how to set your stop losses right. So in this instance, let's say you were buying at the bottom trend line, right? Because you see that price has found support on the bottom trend line like once, twice, three times, okay? And then so maybe at this point right here, you buy at the bottom trend line and you would have got a nice little trade out of it. But what if you were looking at Homo at this point right here after seeing that, hey, price found support like multiple times, right? So it's going to be safe, right? Price is respecting the trend line. So let's buy here. And then we are going to break out and we are going to the moon, right? I'm going to be an overnight billionaire and let's go, Lambo. So you take a trade here, you enter here. So how do you set your stop loss in this instance? So in this instance, right? Remember in the first episode, I talk about when you front run, you sort of have to anticipate what kind of patterns might form if we do break down. Now, usually ascending triangles tend to break into bull flags because if you break down from here, now if I draw a trend line just like this, imagine if we break down from here and price just, consolidated inside this bull flag, right? Can you see this bull flag? So you sort of have to anticipate what might happen next, right? So in this case, you would have anticipated, right? At least I would have anticipated there to be a bull flag forming because any other pattern other than a bull flag is probably not going to make sense in this instance. So if a bull flag were to form, then I'm going to have to expect the price to sort of hold this level, right? You can see this, right? This bull flag. So if we are front running the pattern, where do we identify where is a safe range to dollar cost average and where is the point where our trade would get invalidated? So in this case, if you were front running, either you're going to set your stop loss right below this swing low right here, because if you watch anything about the trends, you know that when we are identifying, like lower high, higher highs, higher lows, higher highs, higher lows, you know that price tends to find support at the previous low. As you can see from this candle right here, when it reached this point at right here, the price tended to bounce a bit. But granted, market conditions might have been a bit bearish at that time, and we sort of got a bearish retest before ultimately heading down further. So in this case, how would you set your stop loss? So stop loss number one is for sure over there, just right below the swing low, okay? Because if you're front running this ascending triangle and you weren't trying to anticipate what might happen next, then all you have to do is set your stop loss at the breakdown of this ascending triangle, right? Because ascending triangles tend to break towards the upside, but if it does break to the downside, then you're out with a small loss. But what if you want to go a little bit, riskier and you really want to do this front running thing for real? So how do you set your stop loss in this case? So since we were anticipating that this bull flag is supposed to form, then we just set the stop loss below this bull flag, right? Because if the price breaks below, then you would have got stopped out. Your bull flag idea was wrong, and you just get out with a minimal loss. So in this case, let's take a look at ATR again. You can see that the ATR indicator shows that it's about 0.11. So this is our bull flag support right here. So if we just go down by 0.11, we would go to about 1.28-ish, okay? So this would have been your stop loss. And in this instance right here, you would have actually saw that we would have got stopped out before the price moved higher as we were predicting it to. And that is the dangers of front running, because you don't have volume confirmation, because not everybody is front running like you. In fact, only a small minority of people are front running. Most people, including myself, right? Including myself, I love buying breakouts. Like, it's so safe. It's such a safe trade to take. Generally, buying breakouts, amazing, right? But front running, although the rewards might be bigger, the risks are inherently much higher as well. So again, another thing that I want to talk about stop losses, right? Is stop losses is how you calculate your risk. Now, if you haven't already read through everything in the encyclopedia, and I mean everything, I do not want you to be taking any of my trades until you watch everything in the encyclopedia. And I mean it, everything. Because over there, I teach you how to calculate your position sizing and how to calculate your risk. And if you do not understand that, then there is no way that you are going to be able to trade using stop losses effectively. So there is a sort of misconception about stop losses, right? Especially by beginners, that they sort of think that stop losses they have to be a certain percentage. And that is simply not true, right? Again, stop losses are simply a way for you to exit the trade with a small loss if your idea gets invalidated. It has nothing to do with percentages. The percentages are a byproduct of how much risk you're planning to take. So, for instance, the way you calculate your position sizing, right? Like before you even enter a trade, you have to have your stop loss, your entry, and your profit targets planned out. Because if you don't have your stop loss, you're not going to be able to figure out your position sizing. So for this instance right here, let's say my stop loss was here. Let's say I foresaw that the price is just going to come down here, find support at this level right here, which is a support line, by the way, before bouncing higher. So I set my stop loss right below here. So my entry to my stop loss would have been about 20%. And by the way, 20% stop loss is really, really wide. And I do not condone taking such a wide stop loss. But, in the event that you are taking a trade with such a wide stop loss, if you didn't know that your stop loss was going to be 20%, right? Let's say that you were entering with 100% of your account size, which means that if your trade would have got stopped out, you would have lost 20% of your account in that singular trade, which is contrary to what I always preach about in the encyclopedia about not risking more than 3 to 5% of your account in any single trade. So in this instance, if you did not know how wide your stop loss was going to be, you would not have known what kind of a position size to enter in. So in this instance, because you know that the price is like 20% from your stop loss, I will go in with a very, very small position because the stop loss is that wide, right? Let's say my account size is $1,000 and I'm risking, let's say, $50 in that trade. If the price went down by 20%, I should only lose $50, which means my position in this case would only be $250 instead of entering with my whole account, because 20% of 250 is 50. So that is how you calculate your position sizing. And seriously, if you have not already read through the encyclopedia, I need you to do that, right? A lot of people get into leverage trading without first understanding position sizing, and that is how they get absolutely fucked. I'm telling you, leverage isn't a way for you to increase your risk. It's a way for you to get exposed to multiple positions at once. And you can only do that effectively if you know how to calculate your position size accordingly. So again, it's a very subjective game, right? Setting your stop loss. When you do it often enough, you sort of get the hang of it. You sort of just like, okay, so this is the trade I'm taking and where's the stop loss going to be? And that is a reason why I like using the EMAs as an area of value so much, because I know exactly where to set my stop loss for EMA trading. If I'm using the EMAs as my area of value, I can just set my stop loss right beneath the EMAs, because I know that if, right, in this instance, let's say I'm expecting the price to bounce at a 200 EMA here. If it breaks down below and get a bearish retest, right, at this point right here, I would have got stopped out and I would have saved myself the trouble of all this bullshit right down here. So it's the beauty of a stop loss, right? You sort of get the hang of it after doing it for long enough. So when you're first starting out, just play around with stop loss levels, right? Post your ideas in chart ideas, you know, with your take profit levels, with your stop loss levels. Where should we buy the breakout at? Where do you think we should set a limit? Post these ideas, man. That's the whole reason why, you know, I'm in the group for a reason. I'm there to help you guys. So the best way to learn is to actually try posting ideas yourself and getting feedback from me or somebody else. So yeah, play around with setting your stop loss. And for those of you who do not know, and guys, one last thing. When I say buy a breakout, right, I do not ever want to hear people asking me about where the fuck to put the stop loss at anymore, okay? When you buy a breakout, you place the stop loss inside a pattern, because if it falls back into the pattern, then your breakout idea would get invalidated. Okay, I don't want to hear any bullshit about, oh, he's posting the chart, but he's not calling a stop loss. What kind of a trader is he if he doesn't call a stop loss? Bitch, I teach this in the first fucking episode of Breakout Trading. Like, you're supposed to set your stop loss inside the pattern, right? I don't believe I have to repeat that. But anyways, with that said, all these videos so far have been me simply doing a brain dump. So there is a lot of knowledge that I'm trying to condense into video format. So if there's anything that you do not understand, I'm going to need you to rewatch the videos, okay? Heck, even I learn new things whenever I rewatch these videos. And I'm sure that in the future, if I miss something out from stop losses, I am going to make another video about it. But for now, rewatch this video if there were concepts that you didn't understand. And with that said, may the gains be with you, my friend, and peace.